So let's jump into the topic for today. What are the important laws for government accounting? So this is looking at achieving the effective financial stewardship within your respective local government. And really, the best way to effectively meet the requirements of the law is to, first of all, know what they are. Now, this is no means meant to be an exhaustive list of laws that are important to you. There are way too many of them. And in fact, far from it, this could be the beginning of a whole series that I do in the future. There's a lot out there, as I'm sure you are well aware. One other thing, I'd like to give a disclaimer right up front that nothing that I say today is meant to be any kind of legal advice, but merely informative, just to let you be aware that these laws are out there and that they exist. If for further clarification, you can consult your own legal people, whether that's your city attorney, your state's attorney, or the North Dakota League of Cities. So let's take a look at the laws that we're going to look at today. We have the local government mill levy determination, the municipal budget law, and those two, the next session, Heath will get a little more into the heavier budget stuff, but I'm just going to touch on some of the basic parts of that. Then we have municipal utilities, the highway tax distribution fund, parks and park districts, the rural fire protection districts, public libraries, the city job development authorities, municipal arts council, and the city visitors promotion. And these are the various state laws that we're going to be looking at. These affect all types of local governments. But no matter what type of local government you are, make sure you listen especially to these first two sections where I touch on some of the budget things with mill levies in particular, because those do affect everybody. So local government mill levy in North Dakota Century Code Title 57, Chapter 15. Title 57, that is the taxation title of Century Code. You'll note that it says there in Section 31, need to determine. And then there's a list of things that are needed to determine in order to compute the local government mill levy. And this section is entitled the determination of levy. It outlines how a municipality is authorized to levy taxes must compute that property tax mill levy. Now, these items will be more closely examined in the next part of the presentation under the municipal budget law. And then we'll swing back to this slide for some concluding thoughts on this. So if we look at the municipal budget law found in Title 40, Chapter 40, and Title 40 is municipal government. So everything that's in Title 40 has to do with municipal government. And then Chapter 40, and then we see here in Section 5 that the preliminary budget. Now note that all of this slide here is referring to the preliminary budget. That's the first budget that you have to submit before the public hearing. So the preliminary budget must include a detailed breakdown of the estimated revenues and appropriations requested for the general fund, each special revenue fund, and each debt service fund. Now this title, because it's in Title 40, the municipal section, this governs all cities and park districts. So, and we'll come back to why this is important for everybody else later. But notice though that it says that the budget's needed for the general fund, each special revenue fund, and each debt service fund. Noticeably missing are capital project funds and enterprise funds, for which you are not required to submit a budget to the county. Next, it says that the budget must include revenue and expenditure items for the preceding year, plus estimates for the current year for each fund. So again, there's only a one-year look back that's required when you're putting your numbers together, your expected revenue and expenditures, and these numbers help you determine what your estimated appropriations are for the next year. But while only 1 year look back is required, it's not a bad idea to do more than that, just to have the information available so that you can prepare the best budget possible. The next section there says the budget must include any transfers in or out, plus the beginning and ending fund balances for each of the funds. So transfers should be included because they affect the mill levy. So let's take a look at a couple examples here with the general fund. So with the general fund mill levy, If, for example, you are planning to mill for levy or tax money for a future purchase, this would be like for a capital project fund, and you want to do a transfer into a capital project fund, you want to include that transfer as part of your budget because that's monies you're saving for a future purchase, and you want to start collecting that money now. That means you need to increase the amount that you have to levy now for that future purpose. And that's why you want to include that transfer. In that case, it's a transfer out. Now, on the flip side of that, you also need to account for transfers in. And transfers in, an example of that, and we'll talk about this in a little more detail later under a different section, but it could be a transfer in from an enterprise fund. Think of like your water fund. If you have excess water revenue, you can transfer a portion of that into the general fund. And so that would be monies coming in that would be available for those appropriations that are going to happen next year. So that's an action that would actually decrease the necessary mill levy that you need to do. And so that's why you need to account for those transfers, is for that reason. Looking at the next item there, it says budgeting for an equipment replacement or building reserve fund. So an equipment replacement fund, you can budget money to set aside for the cost of replacing equipment that will eventually become worn out, damaged, or obsolete. And these equipment replacement monies must be run through a special revenue fund. And the reason for that is because they're restricted for that purpose. Special revenue funds have a restriction. That's why they're set aside that for that manner. Now, the maximum amount that you can budget annually is based on the annual depreciation of all equipment at its current value. Likewise, the building reserve fund is also a special revenue fund that you can budget separately for. And again, this is setting money aside for a future cost. Now, these go into a capital projects fund. And this is for the future cost of purchasing, constructing, and remodeling of buildings and structures that may become obsolete, substandard, or generally unfit for use. So this is a way to set money aside for those future expenditures ahead of time so that you don't have to try and come up with it all at once. Again, the maximum amount that you can budget annually is based on the annual depreciation of all the buildings and structures for a given year. So continuing with Title 40, Chapter 40, we see here that the final budget must include, so again, remember that previous slide was all talking about the preliminary budget. Now the final budget must include the preliminary budget plus the following. And it lists there, so it must be the final appropriation amount, which cannot exceed the preliminary budget amount. So just to quickly run through that timeline, so we have that in our heads, the preliminary budget is due to the county on August 10th, which is actually rapidly approaching for those of you out there listening. So that's when the preliminary budget is due to the county, is on August 10th. Now, from September 7th through October 7th is when the period of time in which you are supposed to have your public hearing on that preliminary budget. And then October 10th is the deadline to submit the final budget to the county. Now, that final budget, it can go down from what your preliminary budget was, but it cannot go up. Okay, so that preliminary budget, you got to make sure you include everything in there that you want, because you can't increase it after that point. Now, based on public input and that kind of stuff, you can lower some things, but you cannot increase after that point. And that's what this is stating here. We'll see there in number 2, it includes the estimated amount of cash on hand at the end of the current year. And then number 3, the levy amount, which is your total appropriations plus your cash reserve less your total resources. And then there's a 5% delinquency. And then 4th is the certificate of levy, which is actually just your Word doc that includes the summary of the amount levied for each fund plus the total amount levied. So really the key to this all comes down to number 3, that levy amount. And again, this will be talked about more in the next session, but just to set up that basic formula so that everyone has that base understanding of what this levy amount is, let's go through and dissect that formula. So the first part of that is the total appropriations. So what are total appropriations? Well, the first part of that are your estimated appropriations for the next year. Okay, and the way we got those estimated appropriations, you'll recall back on the preliminary budget slide that we talked about, you put together your estimated revenues and expenditures for the preceding year plus the current year estimated. So those 2 years worth of numbers, and remember I said it's not a bad idea to have more than that, but those 2 years help you to project what my estimated expenditures will be for next year for that fund. And again, that fund being the general fund, all special revenue funds, and the debt service funds. And most of those are pretty deterministic except for the general fund. So the general fund, the main one we'll talk about here is you need to estimate what do we think we're going to spend? What, based on historical costs, based on projects, things that we know are going to happen, how do we come up with that good estimated appropriation for next year? So that's the first part of it. The other part is you add to that transfers out. Again, as I mentioned previously, the transfers out are money that you are collecting now for a future purchase. Okay, and those are those transfers that go out to capital projects fund. So when you add those two together, your transfers out and your estimated appropriations for next year, that gives you total appropriations. Okay, so that's the first part of that formula, total appropriations. Plus cash reserve is the next part. Well, what is your cash reserve? Well, if you look down at the bottom part of the slide there in section 27 of Title 5715, it says that the budget may include an item to be known as the interim fund. Okay, and this is allowable for all local governments except school districts to carry forward up to a 75% reserve. Okay, so this interim fund or the 75% fund rule is that what that 75% is, that cash reserve, that's that 75%. So let's take a moment for look at how do we determine that? So it says in code that it may not be in excess of 3/4, that would be 75% of the current annual appropriation. It also says in code that in no case may it be in excess of 9 months, that's 9 out of 12, again, 75% of the cash need for 9 months of the next ensuing year. So basically that 75% rule, it's of the current year and of the ensuing year or next year. So you can think of it as the lesser of 75% of the lesser of the current appropriation or next year's appropriation. That's the 75%. And that cash reserve is meant to cover things that you didn't expect. Maybe bills that were held over that didn't get in time before the end of the year, emergency situations that come up, things unexpected for, unplanned for, they always happen. And so that's what that cash reserve allowance is for, is to say, hey, we know you can't predict everything in this budgeting process. So we're going to allow a 75% reserve amount that you can add on top of what you think you'll need. So that now becomes our total need for next year. We have our total appropriations, which again is your estimated plus your transfers, plus now this cash reserve, that creates the total need for next year. So now from that, you see in the formula, going back to number 3, it says less total resources. So then what are the total resources? Well, first of all, it's whatever estimated revenue you think will be coming into this fund. Now, remember, estimated revenue is not talking about this whole property tax mill levy that we're trying to come up with. It's talking about other revenue. What other revenue is coming into this fund? So, for example, for the general fund, you could have other things come in, other miscellaneous things. It could be expected insurance monies. It could be fees or fines, other types of revenue of that sort that would typically come into the general fund. That's what you're including for estimated revenue. Now to that, you add transfers in. Again, remember our example, we talked about transfers in from potentially your enterprise funds of excess revenue you've collected there. So you would add in any of those transfer amounts. And then finally, the last piece of this is your fund balance at the end of the year. Or as it says in number 2 there, the estimated amount of cash on hand at the end of the year. So now you take those 3 components, and the reason you add that in as well, if you think about it, is if you have money left over in the bank at the end of the year, that is money available to pay for the total need that you have for next year. So you add those 3 things together, your estimated revenue, your transfers in, and your ending cash balance at the end of the year, that becomes your total resources. So now if you look at that formula again, it's your total appropriations plus your cash reserve, that's your total need, less your total resources, and that is what determines your mill levy. And then finally, there is a 5% delinquency allowance. The law does allow that you can add back 5% of the amount that you levy as basically the uncollectible portion, because as we all know, not everybody pays their property taxes as they should or when they should. So that's taking a look at how that formula works. So now, after we've talked about that, let's swing back to that first slide. And I added an additional section onto here. But again, back to, and this is in Title 57, which is the taxation title. Now, the difference here is that Title 40 that we were just looking at under municipal government, that was specifically for cities and park districts as defined in that title, okay? But it gives us an idea of what these terms mean when we look at it in the tax section. So if you look down that list, at those items there that are bulleted, estimated expenditures, that's what we just talked about. The reserve fund, that's at 75%. Ending cash balance, that's at the end of the year. Your estimated revenues coming in. And then the allowance for 5% delinquency. So again, now these terms are all, you understand what these are looking for based on what we just looked at in the other section of code. So that was, again, that was more back to 40, but it gives you that idea. So now let's look at the next section, though. If we look down at 570201, so, and it's actually in subsection 9 of that, we see that as used in this title, so this title meaning Title 57, now the taxation title, as used in this title, municipality or taxing district means a county, city, township, and park district, but also includes school district, irrigation district, rural fire protection district, and just in case you haven't been named yet, or, notice, or any other subdivision of the state empowered to levy taxes. So in other words, all local governments are required to prepare a budget in accordance with this section. So now everybody understands why the importance of what we just went through, while that other section was geared specifically for cities and park districts, really those same principles apply to all local governments and in helping them to prepare the budget process and in determining that mill levy. So from there, let's move on to a new section. Back to Title 40, which is municipal government. Chapter 33 talks about municipal utilities. We see there in section 10 that all money received by a municipality for the service of any utility owned and operated by the municipality must be kept in a fund known as the Municipal Utilities Fund, which can only be used for the purposes described in this chapter. This is an enterprise fund, what we refer to in the accounting world as an enterprise fund. And an enterprise fund is a business type fund. Think your big three, your water, sewer, garbage are your most obvious ones. And basically, it's meant to operate, an enterprise fund is meant to operate like a business. Now, you'll recall back at the beginning of my discussion, enterprise funds were one of the funds types that you are not required to prepare a budget for, or submit a budget to the county, I should say. It's still a good idea to do some form of budgeting, because if it's operating like a business, you want to make sure that whatever revenue you're generating for this fund is sufficient to cover the expenditures for this fund. Okay, the purpose of this fund is not to lose money. So you want to make sure that you are charging a sufficient amount to cover your costs. Now, there is nothing saying that you can't charge an amount greater than what you need. In fact, it would probably be wise to an extent, because in the water, especially in the water fund, inevitably, you're going to have situations where you have to replace a water main line, or because of lead, or maybe something breaks and you have to replace it. When the expenses come up for water, when stuff breaks in your water plants or in your water treatment facilities or whatever you have, it's something that needs to be addressed immediately, and it's typically expensive. So you probably want to have the money on hand to cover that cost when that happens. Now, these funds here, this enterprise fund, it refers to as the municipal utilities fund. If you only have one of those options, if you're a small rural area, your garbage is contracted out to the county, sometimes the water is, sometimes the sewer is, whatever purpose. You may only have one of these funds. You may not have all three of those typical funds. However, if you do have the separate ones, if you determine separately, if you track separately the cost associated with that fund, and thereby can determine what we need to charge the residents in order to cover those costs, then those should actually be kept in their own separate fund. You should have a separate fund for the water and the sewer and the garbage. And again, the reason is each of these are meant to be run as a business. And the way think of it this way, the bill that you send out to your residents, if it lists a separate charge for each of those, that means you're tracking them separately. You kind of know what the different costs are. They should be listed on your financial report form that you submit to our office. If you're a smaller government, which is the majority of the local governments out there, those should be each in their own separate fund. If they're combined because water sewer is just kind of all thrown in together, and you don't really differentiate in those costs, and the rate you come up with covers both of them combined, that is fine. And if that's the case, then it's just referred to, as it says there, a utilities fund. Okay, so I just wanted to get that point across. We see now in section 12, it says that only in the event of a cash surplus above the needs of the fund, a total sum of not more than 20% of the current year's revenue can be either invested in interest-bearing bonds or transferred to the general fund. And remember, I used that example earlier. Well, here's the piece of legislation that allows that to happen. In your enterprise funds, those business type funds, if you have excess revenue and you want to transfer up to 20% of that annual revenue amount into your general fund, you can do so. Okay, now you are limited to 20%. Now there is one case where you don't have to worry about the 20% limitation, and that is if you are transferring into a capital project fund that's related to that enterprise fund. So for example, if you have a capital project fund set up because you're going to replace your water tower, you can transfer as much money from the water fund as you want into that to pay for that water tower. Okay, there's no limit there because it's related to the water. It's when you transfer to the general fund or other special revenue funds that you're limited to 20% of whatever revenue you collected for that year. Now note though that it does say that it's only if it can afford it. So that means that the fund has to be able to support the transfer. So if your fund balance is negative, you can't transfer out of it. If the transfer would cause the fund balance to go negative, you can't do the transfer. Okay, so the fund has to be able to support it. Now, if you transfer it to the general fund, those monies can then be used for any purpose that you want. You can transfer to other funds. It doesn't have to just be to the general fund. as I mentioned earlier, you could do a capital project fund, but you could transfer extra money into one of your special revenue funds. That is okay. However, note that special revenue funds by their nature are restrictive for what those monies can be spent on for whatever purpose it was you set that special revenue fund up for. So once you transfer money into it, those monies also now become restricted. So it's just something to keep in mind. You can do that, but just be aware of the consequences of that. So now if we look down in section 13, it says that a municipality can also sell surplus electricity or water outside of the municipal limits. So outside of your city limits, you can sell it to other customers. This can be individuals, it can be corporations, LLCs, it can be whatever. But in section 14, it says that the sale of that surplus must be pursuant to a contract, and that contract does have to be authorized by the city council. So let's take a look now, moving on to the Highway Tax Distribution Fund. And this is found in Title 54. Title 54 is state government title, and Chapter 27. And we see there, the first one there, it's Section 19, which states that all money received by the county from the Highway Tax Distribution Fund, so this section here is referring just to counties, must be administered through a special revenue fund called the Highway Tax Fund. And again, the reason it's a special revenue fund is because, as we'll see in just a moment, the use of these funds are restricted. Now, special revenue funds, and I've talked about this in past audit summits, special revenue funds can be restricted either because of some law, state law, federal laws that have to do with or how monies can be spent, or it could also be done by a council or board action or commission or whatever your governing body is, can also restrict certain funds. So, but in this case here, it's state law that's restricting, creating this special revenue fund. So then it goes on to say that the monies in this fund can only be spent in accordance with Section 11, Article 10 of the North Dakota Constitution. And these must be budgeted. And of course, they must be budgeted, as we already talked about. It's a special revenue fund. All special revenue funds are budgeted. So this relates to the counties. Now, if we look in, this is in subsection 5 of section 19. If we look at the next one, or that was 4. If we look now in 5, subsection 5, we see all monies received by the cities. So basically these two mirror each other, okay? One is for counties, one is for cities, but they're both basically the same thing, as we'll see. So there it says all monies received by the cities from the Highway Tax Distribution Fund must be administered through a special revenue fund, again, and can only be spent in accordance with Section 11, Article 10 of the Constitution. Okay, so same song and dance there. So what does the Constitution then say that these highway tax monies can be used for? Down at the bottom, we see that it says the highway tax fund monies can only be used for the construction, the reconstruction, repair, and maintenance of public highways and payment of debt incurred to do such things. And what that last part means simply is that you can do a transfer from this fund into a debt service fund to help pay off whatever your annual loan or bond payment is, if the reason that debt was incurred was for a highway project. Okay, so that's what that's referring to. So moving from there, let's take a look at park districts. Back, as you can see, Title 40, we're back to the municipal section, Chapter 49. So Section 3 says that you need an ordinance to create a city park district. Section 10, and just for reference, and Section 7, which I don't have on the slide, but these park commissioners are elected positions and they can be paid a monthly stipend. So moving on to Section 10 there, it says that they're entitled to be compensated in accordance with their approved park budget. So while they can be receive a stipend, you just put that in as part of your budget. In Section 12.1, we see that a park district may provide funding from its general fund levy for forestry activities. Now, also, I should point out here that not only can the park district provide money for forestry activities, but the city can as well. The city can do it instead of or along with the park district, all right? So, but they must be spent for forestry activity. Well, what are forestry activities? Forestry activities are controlling diseases, the purchasing, planting, and removing of foliage. It could be pruning and maintenance, purchasing equipment to do such things. It could be the personnel costs, or it could be contracting for services for other people to do all of those things. Okay, so those are all forestry activities that you can set aside money for. And then in section 12 down at the bottom, we see that park districts can levy a tax upon all property within its district to defray its costs. And the reason that that's an important thing to note is that this is what differentiates between city parks and park districts. The latter of which, park districts, which is set up by this section of code, that is who needs to file with our office an annual financial report separate from the city, because they are considered a separate legal entity because they are able to do their own taxation. So, and that's separate and that's different from a city park that's run by the city, and they use their own finances for that. So moving on then with the park districts in the next section, we see that they can do a budget, which we already talked about back in 4040. They were part of the municipal budget law. And in section 11, we see that the tax levy is limited to the amount necessary to meet the budget appropriations. Of course, that includes your reserve fund, your transfers, and all that sort of thing, which we already talked about. Section 12, it states that the maximum general fund levy for a park district is 38 mills as the maximum. And then down in 12.3, we see that in addition to the general fund levy, a park district can also levy an additional 5 mills. So this is separate from the normal property tax levy of 38. This is a separate one for the land acquisition and recreation facilities. So again, because it's separate and because there are restrictions, that money has to be, can't be a part of the general fund for a park district, has to be in a special revenue fund, again, created by code because there are restrictions. So what are these funds restricted for? Well, in code, it says that it's restricted for acquiring, constructing, renovating, repairing, or furnishing recreational facilities and the purchase of land to hold those recreational facilities. So what are recreational facilities? Well, those are commonly understood to be a building or place that is open to the public and provides indoor or outdoor activities. Okay. And since there are separate restrictions, again, that would be in a special revenue fund. So moving on to rural fire protection districts. Now we are in Title 18, which is just simply titled Fires. And in Chapter 10, it has to do with the rural fire protection districts. Again, another entity that is required to submit an annual report to our office. We see in Section 1 there that it's created upon a petition of the county of greater than 60% of the people living within that district, that proposed fire protection district. Now note, any city that is located within this fire protection district, whether such city has its own fire department or not, they can also be included in this rural fire protection district if greater than 60% of the people in that city also signed the petition. So just to be aware of that. Again, a budget estimating probable expenses, as we talked about, everybody needs to do the budget. The next one, the maximum mill levy is 5 mills. That mill can be raised to 13 if voted on by a majority of the people in that district. And that increase over 5 mills is limited to 10 years or the time necessary to repay the debt. So that kind of leads you to see what the excess mill is for taking out loans or what have you in order to buy fire equipment and or vehicles because emergency vehicles are quite expensive. And then finally, it says in an annual report, besides being submitted to our office, must also be provided to the county auditor, and that must show the ending fund balances of the rural fire protection district. So continuing on there, this is section 15, which basically, to sum it up, it's basically saying that there are services, they can provide services to other organizations located within the district, besides your normal citizens and such. And if so, then they have to pay a certain amount, and then that amount, whatever that is, has to be reported to the state fire marshal. So that's what that section is stating there. So moving on to public libraries, again, in Title 40 of Municipal Government, this is Chapter 38. It says that a vote of the people is needed to establish a city library. And the library is to have its own special revenue fund in Section 2. And so that fund is to be used exclusively for the establishment and maintenance of library services. And then the library board, so there's a library board that must be set up, that they have to file an annual report, and they also have control, as you see down in Section 4, of the library finances. And so they're the ones, the board ones, decides the expenditures, the money that goes in there. Also note that the board members, they can be compensated at a rate established by whoever appointed them, either the city council or the county commissioners. So continuing with public libraries, we see that as noted in the first section there, they can have a maximum mill of 4 mills. And note that this does not count towards the city's maximum of 105. A city has park districts, remember, their maximum was 38, cities are 105. The 4 mills that a city does is not part of that 105, okay? And then we see there in Section 1 that libraries established under this section are eligible for state aid grants. And these are coming from the state library. They have to be applied for. You have to participate in their network at the state library. And they use a funding formula, which is based on population and things of that nature to determine those amounts. So in Section 6 there, we see that grant funds, they must be used for the purchase of library materials, supplies, and equipment. Again, special revenue fund, because there's a restriction in code. Equipment, library staff, salaries, and services. So basically everything a library does except for the purchase of land, construction of buildings, investments, that kind of stuff. So, and then the last thing is that they also must submit, again, besides submitting an annual report to our office, separate from the city, they would also need to submit an annual report detailing all of their expenses to the state library. And note that this report to the state library is not just all of their expenditures of the grant money they received, it's all of their expenditures, including the other that they get from the 4 mills. So moving on to city job development authorities, also in Title 40. This time, Chapter 57.4, the City Council can create a job development authority, or commonly known as a JDA. And as you can see there in Section 2, they can be reimbursed for expenses, but they do not receive compensation for their service, unlike the other ones that we have talked about. We see in Section 4 that they are authorized to levy a tax. The money received for the JDA from the JDA from the city is to be kept in an agency fund. And the reason it's an agency fund is that's a fund that basically means this isn't your money. And so a city will oftentimes have, if in this case, if there's a JDA and they receive money for it, it sits in an agency fund, and then it must be transferred monthly to the JDA. Okay. Another example of an agency fund would be if a city receives state aid for a park district, because all state aid goes to the city and then they're required to distribute it to the park districts. So that would be another example of an agency fund. And then again, as you can see in Section 4, they also are required to submit an annual report with the city showing their ending fund balance. And in the bottom, you can see in Section 10 that they also have a maximum mill levy of 4 mills. And again, this 4 mills does not count towards the city's maximum of 105. So going on to the Municipal Arts Council, again in Title 40, Section 38, Chapter 3801, vote of the people needed to establish board of directors of 5 to 9 appointed by the City Council. Again, these are not compensated. And we see down in Section 2, special revenue fund established by the city for its funding. So this money is to be kept separate. And additionally, any other money received by the federal government, the state government, The city or any private source also must go into this special fund that that money is to be used for restricted purposes as noted in this section of code, which is basically the establishment and maintenance of the Arts Council, and as well as grants to appropriate organizations within the city. And then we see down in section 2 that the city may levy up to 5 mills. And again, this 5 mills does not count towards the city's maximum of 105, just so you're aware. And of course, these monies are to be used for the Arts Council. Now, notice in the bottom, section 9 there, any city with a population of less than 2,500 can appropriate annually from its general fund an amount not to exceed $5 per capita, which means per person, to also be, and this does not have to be voted on. The city can just choose to do this. The reason this is here is because for those smaller cities, they don't have the population or property tax base to raise a lot of money, and this allows them to still be able to contribute money to have an arts council for those smaller communities that may not be able to afford one otherwise. And then our last section, we're going to talk about the city visitors promotion, again in Title 40, Chapter 57.3. We see that you can establish, as it says there in 02, both a visitors promotion fund and a visitors promotion capital construction fund. So there's 2 different funds at play here. And a visitors committee would oversee administering the proceeds from the taxes available for these funds. But as well, the city could also contract that service out if they so chose. And then where do these monies come from? We see here in section 1 and in 1.1 and in 1.2 that these are additional taxes, 2%, 1%, and 1%. So the first 2% is on retailers for leasing and renting, hotel, motel, whatever. So, and it's for periods of less than 30 days. So it's targeting the travelers and tourists and stuff. And that money goes into the Visitors Promotion Fund, which is used to attract visitors. The next one, section 1.1, that's an additional 1% tax, which is on prepared food or beverages. Now that goes into the capital, the Promotion Capital Construction Fund, and that's used for the tourism facilities themselves to build those up, etc. And then the last one, 1.2, again, an additional 1% on rental of vehicles, again, for the periods less than 30 days. That also goes into the Visitor Promotion Fund, which is used to attract visitors. All 3 of these, note, are done by city ordinance. So it's the city that determines these. And these are taxes that are in addition to the regular state sales tax that's already applied to these items. So, and then one last thing is that the state tax commissioner, of course, for administering these, will keep 3% of the taxes raised for that. But that concludes my presentation on some of the various state laws that were there. And again, if you want, I included the references so you could go and read more on those and look them up. But certainly, if you want more information on that, consult your legal authorities, whomever they may be, on exactly how these may apply to you and how you can implement these for yourself.